Good evening and welcome to Money, Finance, and You. My name is Gary Omlauf and I'm president of Harris Bank Elk Grove, and I'm your host for the program. Many of you have probably remember a couple of years ago when the subject called NAFTA came up. It was voted, and basically it's a trade agreement between countries in North America. This program, we'd like to give you a little bit of an update and probably an educational program to kind of understand what NAFTA is and what it does. Our guest for this program is Craig Stevenson. Craig is the regional manager for trade finance for Harris Bank in Chicago. Craig, welcome to our program.
Thank you for inviting me.
Before we get into our subject matter, I wonder if you could give our viewing audience a little bit of knowledge on your background, your experience, and some of your responsibilities.
Well, I've been in international banking for many years, basically what used to be called import-export, and over the years has transformed itself into what is now called trade finance, which basically is the exportation and importation of product to and from the United States. Our position is to assist clients that are located in the United States to either export products abroad or import, and then if they are interested in investing in those countries, we help where we can. So it's become a much more interesting product than it was at one point, and then very, very lucrative for clients that are involved.
Well, I guess my first question is, what is NAFTA? And maybe a little background on it.
Well, NAFTA is actually an acronym for the North American Free Trade Agreement, which was a piece of legislation which was signed, as you said, almost 2 years ago between the countries of Canada, the United States, and Mexico. Basically what it does, and what it did initially, was to call for the gradual reduction or elimination of most tariffs on the movement of goods and services between the three countries. The concept was devised to give a competitive advantage over these three areas, these three countries, with other trade areas in the world, such as in the Far East or in other Latin American nations. You have three of the largest economies in the world, Canada, the United States, and Mexico, all existing with borders that hinge on one another. However, up until the NAFTA agreement was passed, each of these countries had a serious and significant tariff issue to deal with. For instance, if a client was trying to sell a product into Mexico that was worth $100, tariffs existed which conceivably raised that price to $200, which meant that the client that was trying to sell that product had a significant problem in competing in the local market. Conversely, the U.S. Consumer who was trying to buy a product from one of the three countries might have had a problem because the pricing after the tariffs were imposed were too high for them to be competitive and raised, in some cases artificially, the price of the product to the consumer. What happened is the three countries got together, and basically the country of Mexico approached the other two countries and said, we need to have a more concise ability to move product and to be trade partners. What can we do about it? The United States felt it was a good idea. They sold Canada on the idea. Canada actually has benefited a great deal more than they thought they would from the start, and it became law. And the first results of the passage of the legislation were quite positive. However, we had several problems with the Mexican economy, which has somewhat altered the scope of NAFTA, and has created a new challenge for us today.
Well, from the standpoint of the beginning of NAFTA, and I remember Ross Perot getting on television and talking about all the job losses that were going to happen, particularly through Mexico, because he was a Texan. How has that affected the Mexican economy?
Well, the onset, again, we have to look at it from two attitudes. The passage of the NAFTA agreement was very beneficial for Mexico. And I'll give you an example. The Mexican economy had been growing quite well. The government had been able to control inflation. Mexico is a vast country of diverse ideas, but it has a relatively young population, which was starting to make demands on the government to create a more cohesive middle class. Now, when the NAFTA was passed and the tariffs were done away with on many products, this growing middle class was able to take advantage of the pricing differential. For instance, at one point, if you were to buy a U.S. automobile, it would have cost you $10,000 in the United States. Again, it could have cost close to $20,000. So the benefit to Mexico was almost immediate and very dramatic. Now, on the other side, anyone in the United States and Canada that was involved in exports realized all of a sudden that they could sell more and more product down there at a great benefit. One of the complaints that Mr. Perot had, and was something that he voiced very vocally, was this giant sucking sound.
Right.
We were going to lose jobs to Mexico. The reality is there were only about 800,000 jobs in the United States that were reliant upon this whole concept, which is not a great amount of jobs in the whole U.S. market. And many of the jobs that actually were lost, and they were lost due to the fact that companies had made a decision earlier to move production facilities to Mexico, just because of the things that we talked about. It was harder to export into Mexico, therefore let's produce locally and either export it or sell it there.
Sure.
And basically the jobs had already been lost. They were gone when NAFTA came along. It was hoped that that would recoup some of the losses, and the start of NAFTA, the first year or so, was very beneficial. Then we had the situation I think we'll talk about in a few minutes, which changed the scenario somewhat.
But at that point in time, it was beneficial to both the United States and Mexico, because obviously the situation was already in the cards as far as companies moving to Mexico. So a lot of that was more wind than it was substance. That's
the prevailing opinion, yes. And in the banking industry, that was definitely the case. We saw a great deal of increase in opportunity.
When you look at Mexico today, and I realize they've had some serious economic problems, how do their economic problems affect this trade treaty at this juncture, and where do you see it going?
Well, you have to stand back and understand what happened about a year ago, just in December, and how it affected it, because it gives sheds some light on what has gone on. The Mexican economy, which has gone through several cycles of ups and downs, had been moving along fairly well. The middle class was growing, people had opportunities in Mexico, they were buying, the government was in relatively stable condition. However, certain forces started to look at the economy and saying perhaps the factors are not there that need to be there for good investment. And what was going on with an inflow of investment into Mexico kind of stalled out, because some of the investors said, we're a little concerned about Mexico. For you that are investing in the local economy, we suggest you either not invest more or you move your money out. So there was some disquiet in the market. At the same time, two significant things happened, which, while they don't have a bearing directly on the U.S. consumer, they did eventually. First of all, there was an uprising in one of the southern states, Chiapas, which I think everybody may have read about, which created some doubt in the minds of the consumer and the Mexican person as to the viability of the government. Then another very traumatic thing happened. The leading candidate for re-election to the presidency, or election to the presidency, was assassinated. They still don't quite know who did it. They're afraid that some of his colleagues got involved somehow, and as a result, some of the confidence the government slipped. That all led them to believe that their currency was overvalued, and so they said, well, we will devalue the currency, which was not an unusual step. It was somewhat anticipated and had been anticipated for a period of time. However, when they did devalue the currency, they were estimating a devaluation of 10 to 15%, which would equalize the markets. When this occurred on top of the investor disquiet, the assassination, and the Chiapas issue, the markets just said, oops, that's it, we're out of here. And all of a sudden, what started off as a 15% devaluation turned into at one point, almost a 50% devaluation. Now, that created a major problem for the middle class, because that product that was being bought at $100 from the United States, that because of the tariff reduction had been reduced significantly, all of a sudden, because of the devaluation, that product was back up to $200. And as a result of that, the consumer, the person in Mexico said, we can't buy it anymore. In December of last year, the exportation to Mexico stopped dead because people simply couldn't buy.
It almost negated NAFTA, basically, because the same price existed before NAFTA as exists today then.
Correct. So for the U.S. consumer that was exporting, the client was the person that worked in the plant that was producing product that was exporting. All of a sudden, they couldn't sell the product, at least in the short run, until the Mexican system equalized itself. But on the other side, and what has happened subsequent to that, is that the manufacturer in Mexico now all of a sudden has a product that is much cheaper than it was before. And with the lack of tariffs, the Mexican product now has become a lot more aggressive and progressive in the market, and you see now a lot more exportation out of Mexico. So for a U.S. consumer, all of a sudden a product from Mexico, which may be of equal quality, was cheaper or at least competitive in our market. So it's kind of reversed itself from what it was originally intended.
Now, is there confidence right now, or is a lack of confidence from, let's say, American firms that would be seeking to locate in Mexico to take advantage of some of these opportunities? Do you see that a flow moving in, or kind of just holding right now to see what happens?
Well, the flow stopped, except for a lot of projects were underway. However, after a reevaluation, we've seen that more clients are now becoming more actively involved in investing locally, because they realize that if they can go down there and they can produce and export, they have a cost advantage.
Okay, so then the ultimate concern is the stability of that whole government, really, and where it's going.
Correct.
Well, let's move to the northern section. Let's go up to Canada, and maybe you'd give us an understanding of how NAFTA has affected both Canada and the United States and along that border area.
All right. What we've seen in Canada, at least thus far, has been the Canadians coming into the agreement saying, we're in this agreement for the ride. It isn't going to do us any good. It isn't going to do us much harm. We're happy. President Clinton, go ahead and do whatever you got to do. They've probably seen more of an advantage than they thought they would see. Product has come out of Canada and gone into Canada. There have been tariffs. There are tariffs between Canada and the United States, which may surprise some U.S. citizens, because the two countries are so closely linked. But there are fairly significant tariffs on certain items. These things have been reduced. Now, that does have a bearing on the market, because all of a sudden you realize that if the tariffs are gone, for clients that are producing product and selling it somewhere else or competing with the Canadian product, the tariffs are gone. So the advantage of protection is no longer there. On the other side, however, our products can be sold there much more readily than they had been. The Canadian economy has seen a recession, however, and as a result, some of the markets are down. The Canadians overall have been fairly greatly benefited by the whole process, and they're somewhat happy with it. They're more happy with it now than they thought they would be. We'll see where it goes. However, because there are different provinces in Canada, we've seen some taxation on tariff issues coming out of provinces and not necessarily the central government. So they had what they called the wheat war and the timber war, where provinces were levying tariffs on U.S. products going in, just because they felt that they were going to compete with the local economy and the local products. People in the Pacific Northwest, for instance, saw the effect of that, the benefit or the detriment. People in Michigan saw that as well, because of their close link into the Canadian market. So it's been pretty good for them. Better than they thought, but there's still some issues that they need to contend with.
Has it been mutually beneficial for both the United States and Canada, or has it favored one side or the other?
Well, NAFTA probably was favored more towards the United States economy than either other economy. However, the reasoning excuses that by the statement simply that the United States economy is so much larger than either Canada or Mexico. For instance, the entire economy of Canada is akin probably to one of the major metropolitan areas of the United States, for instance, Southern California or the Midwestern Chicago area, the New York or Northeastern United States. Their economy is a lot smaller, therefore they have more to gain and more to lose with changes in the status quo.
In Canada today, there's obviously a major issue that exists there, and that is the province of Quebec, whether it stay Canadian or become a separatist country in its own. Maybe you could explain to our audience a little bit about this referendum, what it means in terms of its overall ramification, and the follow-up on that as far as what occurred and what the future might hold. That's a three-part question there. I don't mean to
let me try it, and then we'll see if I answer it completely. I think, first of all, people need to understand what the referendum is. It was not a vote for secession from the Canadian government, from the Canadian nation. What it was a group of separatists who said in a legal ballot, we want the issue of separatism put on a national ballot for consideration. This has been the battle all along. There are a group of people in Quebec that want to secede from the Union. However, they cannot do that until the entire country votes on it. So the battles have gone forward for years and years as to whether or not the Canadian people would allow that to be put on into a national forum. This referendum came in, depending on what your view was, against the separatism issue, but it came in by such a narrow margin that we probably haven't seen the last of it. I think the government and the industry leaders were probably somewhat surprised at the narrow margin of victory for them and the narrow margin of loss for the separatists. Going forward, what does this mean? I think you need to step back and understand some of the ramifications if Canada were to separate, to split apart. You have Quebec, which is one of the largest economic factors in Canada, sitting not in one side of the country or the other, but sitting probably towards the middle, saying we want to become a separate country. Now, the ramifications are, what kind of currency would they have? Would they deal separately with the United States and Mexico? Would they be a member of NAFTA? Would they try to be more aggressive in their marketing and product and pricing to get into the markets? What would that do to the United States if our industry base had to compete with that in the NAFTA agreement if they were in it? That could have fairly far-reaching ramifications. Moreover, then you have the whole issue of a country that sits in the middle of another country, and we've seen that in areas of Africa and other areas as well. However, in this case, what would happen going forward to the maritime provinces? What would they say about this? We are Canadian, but we are separated by a country. How do we deal with that? Would they look to separate as well, or join with the Quebec country? And there have been very serious concerns lately about the validity of Canada as a country if this were to go ahead. They've recently decided that one of the separatist leaders would now become or try to become the premier of Quebec. The issue is not dead by any means. I think people are somewhat concerned on one side and somewhat euphoric on the other that this thing is not yet resolved.
Craig, what is the breakdown of the population in Quebec as far as English-speaking and French-speaking?
I don't have exact figures, but it's probably approaching 50-50. Okay. You have a whole group of French Canadians, and then you have a very significant group of English-speaking Canadians as well. And there has been a lot of pressure between the two groups. It's not a real strict minority issue.
As far as the future within Quebec itself, so they have no idea who their principal trading partner may be, and it probably would ultimately be Canada anyway, if
probably.
That were to occur.
Or the northeastern United States.
But you also alluded to other concerns about Canada in the event that Quebec were to, number one, get on a ballot and to actually secede. What concerns do you see for other provinces? Is that something that could arise elsewhere in the country?
Well, again, I think in the maritime provinces it would become a dramatic issue.
Okay.
You look west, however, to British Columbia and the Intermountain, the Rocky Mountain area. I think their concerns would be a lot less significant. However, you have to understand that Montreal itself is a city, and then the whole province is a dynamic part of the Canadian economy. They have many industries. They have a significant amount of the industry base located right there, which trades across country, which provides jobs and opportunities across the country. And to have this pulled out of this unit could almost create a vacuum and would almost collapse the other units together, and the resulting chaos would probably have a great deal of effect on the American stock market as well as the Canadian markets.
Well, what we've been trying to do here is to at least build a base and an understanding of what NAFTA is, who the partners are, and what some of the concerns are that exist both in Mexico and in Canada, and how it relates to the United States. I wanted to get into more of a consumer issue because we certainly get viewed by a lot of consumers. What does NAFTA mean to the average citizen here in metropolitan Chicago?
Well, I think the basic benefit has been twofold. Number one, we haven't lost the jobs that people said we were going to lose, so people were not affected. They didn't need to worry as much as they thought they would. And I say this, and there are probably viewers who are probably screaming at the television, that's not true because I lost my job. The basic issue is they probably would have lost it anyway. This has not had that big of an effect. However, that same consumer has now said, the company that I work for has probably doubled its exports to Mexico in the last 6 months, therefore I'm a lot busier busier, I'm a lot happier. That was pre-December 94. Now, when the problems occurred, that group of people started to becoming negatively affected. We've seen a lot of that come back, however. That business has come back, adjusted. What we're seeing now, however, is on the other side. The exports out of Mexico into Canada and the United States have become cheaper. Therefore, you may be seeing consumers able to buy products more cheaply. For a long period of time, there was a quality issue. American consumers were a little bit leery of the quality of the Mexican product. If they had their druthers and they had an American product and a Mexican product side by side, they would probably buy the American product. However, because of the industry base down there and the growing concern about this issue, I think you've seen a lot of improvement in quality of products, and you have a legitimate product that you can buy at a reasonably low price now, so the consumers benefited there.Here that goes from here, we don't know. I think one of the big issues and one of the very, very difficult issues that we don't contend with much in the Midwest, but is certainly contended with in the Southwest and California, is the issue of immigration. As this, legal or illegal, as this group of disenfranchised middle-class Mexican people becomes less part of the process, two things may happen. First of all, there may have political pressures, which would create some problems. Secondly, the economic pressures are going to be dramatic. For instance, if you had a mortgage in Mexico last December, it could have conceivably have increased 30 to 50% overnight. If you were paying $1,000, it could have gone up to $1,500 or $1,600 overnight. That's tremendous pressure on the Mexican middle class, which means perhaps more immigration, illegal or legal. And I think you're seeing a lot of pressure there right now, which will continue and I think will spread into other areas of the United States, including Illinois.
Let's switch over to some of the business aspects of it. How can a small or medium-sized company in our area benefit from NAFTA today as far as the jobs? I know you relate back to the consumer's buying power and perhaps in some cases the jobs, but as it relates to the Chicagoland economy and our manufacturing sector, how do you see that? How do you see the benefit for them?
Well, as a banker that's been involved in trade finance for many years, I've seen cycles where products have come and gone, trends have come and gone, clients, importers, exporters have done this business, got into it and got out of it, depending on whether or not they had excess to sell or needed to buy. Over the past 5 years, however, it's become clear to me and to many bankers and many financial people that we are truly entering a global market. You do no longer probably manufacture your entire product in the United States. You either source from somewhere inside the United States that's outside of your factory, or you go overseas, and increasingly they're going overseas. On the other side, you have now product base where you can't rely because you have the infrastructure built, you can't rely upon selling everything you manufacture in the United States. So what has happened now is you've seen companies become more reliant upon exports as a visible tool of sales. In the Midwest, for instance, in the last 5 years, the true export drive that has been very successful has been middle market client oriented. It's a company of smaller size that's gotten a contract to sell $500,000, $1 million, $20,000 to a client in Canada, in Mexico, Far East perhaps, and they have become an integral part of what has gone on, which has created jobs, has created stability for many of these middle market companies. We know there are clients in Chicago, for instance, that have actually changed their names to include the term international, because what was 10% of their sales 5 years ago may now be 60 or 70% of their sales. There's a great need, and in the NAFTA group, that's been furthered by the ability to sell in a more competitive, tariff-free structure.
How does a small or medium-sized company get involved in the exporting side now?
Well, you've got two issues you need to be concerned about. First of all, how do you get the sale? And there are a number of sales agents, there are a number of areas that you can go to if you're interested to try and get your product involved in some export opportunity. Once that gets lodged, then you have customers that come to you, and you have one customer come to you and start the process. Then you have to worry about, how am I going to get paid? What are the mechanisms for payment? And I think the audience needs to be warned that you simply can't sell on open account right off this bat.
Well, you can if you want to take that risk.
Exactly. You have to be careful of it, and you have to do it right. And if you do it right, then you can be successful at it. We've seen clients that have sold no more than perhaps $7,000 or $8,000 per shipment be able to cover their risk and make sales and make continual sales and become very happy with the process.
Well, the key in terms of exporting or importing or getting paid is the mechanism, and it's generally through a bank. It's a letter of credit of types where that at least guarantees payment to those companies. Would you, I guess I'm going to say simply, because it can be kind of complicated, but how does a letter of credit work?
All right. Simply put, the letter of credit is a document, nothing more than that is issued by the buyer's bank, which says to the seller, if you present us with documents proving that you have shipped the product that we describe below, we guarantee to pay you. And it's that simple. Therefore, if you're an exporter, you see from a foreign country a bank letter of credit that says to you, we will pay you. Now, the U.S. exporter may not be willing to take the risk of the foreign bank. So you generally will route these letters of credit through a U.S. bank that it can either advise them, which means acts as an agent simply to make sure the documentation is right, or can confirm them, which adds their guarantee, which means then you transfer the payment risk from the foreign buyer to his or her bank to the U.S. bank that actually deals directly with you. And that's in its simplest form what a letter of credit is. It is not a guarantee of the quality of product. It's simply a guarantee of the quality of the documentation. And I think it's important for people to understand that. Now, if you reverse that, if you're a buyer and you want to make sure that before you pay, you have some proof that the product is coming to you, you're advantaged by doing the same thing. We will pay you, the seller, via a letter of credit, which means basically our bank is guaranteed to pay you if you present documentation. One last note, this again is quality of documents, not quality of product. And we've seen some problems with that because exporters and importers have been confused with that issue, and when they've seen a product that's not to their liking, they've been upset saying, well, the letter of credit, we shouldn't have to pay it because the product is not good, and that is not accurate.
Well, most of these letters of credit, once they're issued, are non-cancelable too, so that way, as you say, it pays on documents only, and somebody gets upset with the quality and they want you not to pay it. You don't have that luxury, and nor do they.
That is correct.
So, from the standpoint of cultural differences in exporting, briefly, we've just got a short time left, but give us some variation on how you view that.
Well, I think in Canada, for instance, if we're talking NAFTA countries, we're talking a society and an economy that matches the United States as well as any in the world. So you see a lot fewer issues. In fact, most companies don't even regard Canada as a foreign sale. It's
seamless.
Included part of their local domestic credit issue. Mexico, on the other hand, should be considered a foreign country. There is a fairly significant language difference, and even though most Mexicans speak English and there's really little problem with it, the methodology and the ability to communicate sometimes gets in the way. You also have two different banking systems, and whereas the United States system with Canada is becoming, as you said, more and more seamless, where things can flow back and forth fairly easily. In Mexico, they can flow, but it's like you rush up to the border, you have to step across the border, then you rush off to your destination. It hasn't yet come to the point where technology allows this to happen very easily, and that's something that can be overcome, but you have to consider that.
Well, Craig, our time has gone by very, very rapidly. I think you've been able to give our viewing audience a general understanding of what NAFTA is about and a little bit of the economic aspect of it from an international perspective. We very much appreciate having you as our guest this month. Our guest has been Craig Stevenson, the Regional Manager for Trade Finance from Harris Bank in Chicago. Thank you, Craig.
Thank you for inviting me.
And thank you for joining us on this month's edition of Money, Finance, and You.